Hi, this is Mike Bernick for Money and Markets. Welcome to this week's Squawk Call, where we go around the horn with all of our editors to give you their insights on the happenings in markets for this week and beyond. Today is Tuesday, July 29th. I'm Mike Bernick, and with us today are Doug Davenport, Larry Edelson, Don Lusick, Bill Hall, and Mandeep Rai. All right, gentlemen, let's go ahead and get started, and we'll let some of the stragglers join us a little later on in the call. Obviously, a busy week this week. We've got a lot of economic data on tap. We've already seen some. Consumer confidence now comes out today. We also have, a little later this morning, we also have GDP and, of course, the jobs report Friday. And if that weren't enough, we have an FOMC meeting, two-day meeting, which concludes tomorrow. Certainly adds some volatility to the market. And in addition to the fact that we've got about 800 public companies that are going to report their earnings this week. It's the peak of earnings season this particular week. So let's go around the horn and see what is on everybody's mind. Doug Davenport, why don't we start with you? You're an observant watcher of market trends. I noticed you've seen an uptrend here recently in China. Why don't you tell us a little bit about the opportunities you're finding right now?
Well, I don't think that's a shock to anyone if you follow the markets and you look at what's happening in Asia, excuse me, and especially China. China's certainly been trying to break that downtrend line for many years since the market peaked several years ago, quite a few years ago. I'm sorry. So that's not really a shock, but it appears to maybe be it appears to be a better breakout than what we've seen in the past, and so in my portfolio, I added China to it the other day. But you could easily add South Korea, too, because I noticed yesterday that South Korea announced a $40 billion stimulus plan. So it obviously pays to be long countries that have active stimulus programs. And South Korea certainly needs to clear that 2008 and 2011 peaks that they've had. But if the South Korea ETF can get above 70, I think that would be a very, very attractive purchase also, like China. And even some of the trend following I follow for the Asian countries. Japan, I started getting a lot of buy signals yesterday for Japan even, which I was kind of interested to see, but who knows if that will last. But I think if you looked at the general market as a whole, you'd have to just say we're nothing more than in continued resiliency. If you look at the price action of all the major averages, you're still seeing a buy the dip mentality that we've been in there, and the S&P right now is in its fourth week of consolidation between 1960 and 1990. If we can break out of 1990, you've got a measured move probably to 2029 on the S&P. If it breaks 1960, we could easily go down to 1914-15 area. Now, not saying that this is certainly any kind of unstoppable bull market, but you do have lots of factors going in the right direction. You've got upward momentum in the economy. We'll see tomorrow how that number looks. Earnings, you've got a ton of that, as Mike just mentioned. And the blended earnings growth rate so far has been 8.75% this year, or this quarter. So you've got most of the companies beating estimates, about 68%. 18% have missed. You've got merger and acquisitions doing well. The industrial sector led the market early this year, if you want to look at sectors of the S&P, but it's kind of now the bottom because Caterpillar was the poster child last week with not good earnings, and it dropped, and so the industrial sector is down. Utilities are acting poorly right now, but you've got energy, technology, healthcare, Asia, emerging markets, bonds, both here and in Europe, doing quite well. And I saw this little quote this morning. It said, if you think that stock markets reflect their economies, well, look at the Ukraine. Their stock market's up 59% this year, so obviously it doesn't reflect the economy in the Ukraine, but I thought that was an interesting return for the Ukraine market. TLT's up 15%. I'm still long there. Who knows when rates are going to go up? I have no idea. I don't think the Fed will raise rates until the second half of 2015, even if then. And I don't know if Janet's going to have to cut her GDP forecast once again because the number comes out, and that's going to be a key report, even though there'll be two more revisions of that this quarter. But I don't know. Once she sees those housing numbers that are out there, that doesn't look very good. And if those housing numbers would give them any reflection, and it may be in the back of their mind that, well, maybe we ought to hold off on this taper a little bit because I'm curious to see. If you're a betting man on the over-under on a 3% number on the GDP, I'd take the under. I think I would go with 2.7% on GDP, which had basically made us flat for the first 6 months if that actually does come out. ITB, which is a housing ETF, that ETF peaked in February, and it's down about $4 a share from a $26 handle back in February. So that number's not good. But the euro, the dollar, that's, I guess, the biggest key is what's the dollar going to do. The dollar peaked or bottomed in May short term, and now it's been climbing ever since. And that certainly, I think, affected the price of gold and oil, especially oil here lately. So you've had the dollar on a short-term uptrend. Now, whether that continues, I guess, will depend on what the Fed does. If they are able to. If they continue tapering at some point, rates will have to go up, the dollar will go up. That certainly doesn't help commodities or international markets. So that's kind of my view of it.
Okay. Thanks for those thoughts. Very interesting. Let's see, Larry Edelson, let's go to you. Obviously, geopolitics have been playing a pretty big role here in what's going on in the markets with the volatility we've seen. A lot of hot spots around the globe. What's your take on that?
Well, it's a long-term process, but it's ramping up. I think it's going to get, it's just going to get increasingly hairy and scary out there. And in my book, that's what's driving everything. It drives international capital flows. It drives currency values. It drives everything. All asset prices from the stock market to commodities. To pick up on what Doug said, the stock market does not have to reflect always the underlying economy. Very often, in times of financial stress, it does not. The reason the Ukrainian market is up so much is the same reason the Zimbabwe market was up 3,000%. The currency is worthless. That's the main reason. All asset prices float, and right now you're still seeing huge capital inflows into Asia and into the United States and out of Europe and Russia. That's why the euro's going down. That's why our markets are outperforming Europe's markets, and it's going to continue. And interestingly, gold is up along with the rising dollar, which is something I said you'd be seeing a lot more of. And, we've seen gold rally quite strongly off of its 1240, 1250 low a couple of weeks ago up to 1312, right along with the strengthening dollar. So, you can't get married to any old rules of thumb because we're still in a financial crisis that has not ended. And during a financial crisis, everything is turned upside down. As far as the stock market goes, I'm expecting one more push up, but then, it's gotta run out of steam at some point. It's gotta correct, and the longer it continues to go up, the worse that correction's going to get. So I don't like being long the stock market here. And I do like being long gold. I'm getting ready to buy natural gas. That's very close to bottoming, and that's probably going to be the biggest bull market of the next 12 months, I would say. And gold is looking good for a run up to as high as 1,400. We're building the base now, so I'm very pleased there, and ditto for mining shares. Another explosion higher in mining shares. That's where I'm focusing my time.
Okay, interesting thoughts on multiple markets. Thanks. Don Lusick, obviously we've seen some pretty good earnings so far this year. This is a peak earnings week right now for the S&P 500. So far I think the earnings are about 6 or 7% year-over-year growth they're showing, which is the best we've seen in the last few quarters. What's your take on which stocks and sectors are looking the strongest?
In terms of earnings?
Correct.
I think energy looks good. They've had strong year-over-year earnings. Financials have had poor year-over-year growth rates. As far as the ratings, the Weiss ratings go, they have been steadily declining for the past couple of months, and that has kept me somewhat cautious. And they look like they're bottoming here, just as the market seems to be consolidating. And what I'm hoping to see is some improvement in the ratings overall. Sector by sector in them. I think Doug pretty much summed up the types of things we need to be looking at right now as investors. The only thing that I would disagree with him on in terms of ratings is the healthcare sector. The healthcare sector continues to be kind of pulling back here in terms of ratings. Now you have to remember, ratings look not only at year-over-year fundamentals, but they look at long-term trends in those fundamentals, and they also look at items such as dividend yield and stock price performance, again, in over multiple time periods. So what we're seeing here, to me, is quite encouraging. I'm seeing what I think is a bottoming process. I'd like to see some more momentum in either direction to sort of either prove that thesis right or wrong, but I'm not seeing it just yet. Maybe we'll get a clearer view based on, as you mentioned, there are a number of earnings coming out this week. So perhaps we'll get some solid data this week that'll be helpful in that regard. Other than that, I mean, really, the three things that you need to look at this week in this order is GDP, SED, and EPS. I mean, yes, it's a bulky part of the earnings reporting season, but I think that the market is going to be driven more by the Fed and by GDP than it will be by earnings. I also wanted to key off of something Doug said earlier about industrials. Yeah, they're not the poster child of any recovery in the stock market or any further upward momentum at this point. We'll see. I mean, check back with me, in a month. But the earnings have not been super in that sector, and the stock market is acting accordingly, I think. I mean, I think that the market is just doing what it does. It always tries to see into the future about 9 to 12 months. No real surprises this week. It is heavy. Yep, we're knee deep in a lot of earnings reports, and so that keeps all of us us data nerds very busy. And we'll see where we can take it from there.
Indeed. Well, thanks for those comments. An interesting insight into the Weiss ratings model. Let's see, Mandeep Rai, why don't we get your take on what you see right now, especially in the small or lower priced small cap arena?
Yeah. Hey. Good morning, Mike. Good morning, everybody. So the Russell 2000 is again back below that 200-day moving average. It's a tough environment for the small cap stocks. We're down approximately 6% in the month of July versus and year to date we're down 2%. The S&P 500 comparatively over that same time period is up almost 7%. This is usually a point where the Russell will bounce up from. Usually meaning it has historically most of the time bounced up from here, and you have a bunch of drivers. Everybody's already talked about the economic data that we have coming out this week. GDP is going to be the big one. Don mentioned that's going to be the one that we're going to try to gear on for the second half of the year. Are we seeing growth? Are all the leading indicators, coincident indicators that we've seen so far that have generally been better, housing, pointing to a growth in the overall economy? The spectrum of expectations is pretty wide. It's the advanced number. There's going to be revisions, as Doug mentioned. 2% to 4% is the expectation. I think if you get a 3 handle, that will be generally positive. We also want to see on the unemployment report, we'd like to see wage growth. We've said it over and over again on the calls, but that's sort of the component that we want to see trickling down into consumers' pockets, helping them feeling more confident with the state of the future, helping them spend more. That will boost spending, GDP. You have a low rate environment, but you don't have folks going into taking on mortgages, buying houses. That's something that we want to see. And we also want to see more full-time job creation versus the part-time, that's going to be potential for sustainable growth potential. Overall, it's been a tough trading environment, as I mentioned, with the Russell being down. The earnings have been good. Just as Don mentioned, overall, we've had slightly over half of the S&P 500 reporting earnings, and you have earnings growth in the double digits, low double digits, around 10.5%, and then you have sales growth around 5%. And that's better than last season. We used the growth numbers, not the surprise numbers, but last season we had 4.6 and 3% earnings and sales growth respectively. We go back to the sentiment and why the Russell is down, why there's a divergence between the small caps and its large cap peers, and it's a confluence of factors. You have investors that are jittery. You have a potential correction that we're statistically overdue for. I mean, how many months? It's probably like 34, 35 months now that we are without a correction of 10% in the large caps, and the historical average is around 18 months. Everybody's talking about the Fed's handling of the end of supportive monetary policy, and you have geopolitical risks. Where we're looking at Europe, what's going to be the impacts of Russian sanctions there? Europe is already in a pretty, sort of teetering on growth and stagnation and decline in production there. So that's something that we're looking for. It's a decision-making environment. We're going to see what the numbers have on tap this week. We would like to see growth confirmed. We'd like to see consumer spending confirmed. We'd like to see the Russell rally. And we're also assessing our portfolio through this earnings season. We want to see companies beat expectations, but we want to see growth. The surprise number is okay, but we'd like to see growth to help us. The valuations, the PE has been running without the E. So if we get earnings growth, that will be supportive of a little bit more movement, upward movement in the markets and in our stocks. But yeah, so we've noticed that because of the decline in the Russell, we buy typically when we get what we see is a potential upside risk-reward ratio that's favorable for us. So we buy on weakness, but because of the volatility and all the noise in the markets, you find yourself overweight in your portfolio, exposed to equities at lower prices, but you don't get the rally. So this is going to be a key week for us. We may be doing some balancing in our portfolio, but we're watching it carefully. And for the longer-term investor, I think it's sort of a just kind of get through this environment, listen, keep your thesis intact, and try to avoid some of the noise. I think we're okay.
Indeed, plenty of noise this week with all the earnings. Thanks for the thoughts, Mandeep.
You got it.
Let's see, Bill Hall, let's go to you. Mandeep mentioned the Fed and the fact that investors are growing a bit nervous about the Fed's impending exit strategy. They've already said they're going to end QE by October. You have correctly pointed out that interest rates would be going down this year, not up, which of course they have. What's your thoughts from here on out?
Mike, I think that we're sort of just like in a grinded out place in the market. I'm looking for the macro themes right now because I believe it's a macro market, not a fundamental market, meaning I agree with Don Lusick, who said I think GDP and what the Fed's doing right now is more important than individual underlying company earnings. So I'm looking at the macro factors, and I don't really see anything that's going to change the trend right now. I mean, we have a market that wants to go up, that continues to go up. It goes up because people don't have any other place to put their money, to make any money. Nobody wants to put their money in the bank and get the nominal rates they get on the CD. The 10-year Treasury is telling us that nobody sees any inflation out there. And when you get a market like this, I start looking around at what could go wrong. As an investor, I've always learned that you need to invest like a burglar. You need to know where your exits are at all times. And one of the things that's concerning me right now is I think we may be setting up for a liquidity crisis. But it's one of these knock-on effects of the fact that the easy money all over the world. We've got easy money from the ECB, we've got easy money from the Fed, and we got low rates, so everybody's reaching for yield. And so what makes me think that there's a liquidity crisis perhaps brewing? You know, you've seen the warning from the Fed about accounting issues at Deutsche Bank. We saw the issue as it relates to the Portuguese subsidiary of a Spanish bank. You know, Banco Espirito Santo has issues. Then yesterday I didn't have a chance before I got on the call this morning, but it's one of the things I want to look at today. I guess we're going to have an Argentinian bank default. So, you know, I don't know whether these are random data points out there or that we do have a real liquidity issue. But in terms of a seize up in the bond markets, but that's what's got me worried right now, and that's what I'm looking for. Absent that, I think it's sort of market drifts higher.
Okay, thanks for those thoughts. Could indeed be a bumpy and volatile summer. Well, let's get your take on the market. I know you tend to follow things from more of a quantitative point of view, following your trading systems quite closely. What are your systems telling you right now about the increased volatility we've seen?
You know, one of the things that we look at is the advanced decline line, and it's getting weaker and weaker. And that's a lot of times when we see the momentum stocks or momentum plays, what we look for is trends. And a lot of the trends that we're seeing are short-lived, or they're starting off to be a trend and they're breaking. And this is typically, this month is usually the choppiest month of the year we're seeing it. But I think that one of the things that we've seen, though, is a lot of the smaller caps, like one of the editors was alluding to earlier. You know, it's been very tough because their earnings aren't spectacular. You're seeing a sell-off. You're seeing a sell-off because people are going to safety. They're buying companies like IBM, Apple. If you look at when the market's negative right now, some of the big names like Apple are the only ones that you see really moving. You're seeing companies like IBM going higher, but if you look at revenues haven't increased. You know, a lot of companies are doing financial engineering where they're doing large buybacks, so it makes it look good on paper. Overall, the earnings have been good. I think on the larger cap companies, large cap biotech have done real well for us. Especially that Gilead had absolutely fabulous earnings last week. The stock sold off on fear of what the government might force them to do, or insurance companies might force them to do with the prices of their products. One of the things that we're starting to see is some large cap shorts coming in. I haven't seen that in the last year, but we've been starting to put some shorts on, and they're actually trending in our direction. So I think this market's going to be choppy probably until September. One of my friends is a trader at a very large firm. He told me, hey, a lot of guys I know are gone right now. This is one of the first summers that we haven't had to really worry about things. So don't look at this volatility as a big problem right now. It's the fact that a lot of people aren't trading. I think that going forward, earnings look good. You know, we've had really good earnings. I think if you take the banks out, the earnings would have been better. Rates are probably going to stay where they are right now. And I think a lot of the economic data is very confusing. You know, some weeks we have good economic data, then we'll get a few reports that seem negative, and then it puts everybody in a tailspin. People are still buying U.S. The reason why they're buying U.S., where else are they really going to put money right now? You see some people buying emerging markets, China, that I mentioned earlier, and a couple others, Brazil, India, because of possible political changes that we might see. So I think there's a lot of speculation on which the market's going. But overall, you know, the U.S. market's still the strongest with everything that's going on in Russia, Israel, and so forth. So we're keeping the track that we're going. We're focusing more on large cap versus small cap just because of the volatility factor. And we're also looking at the short side of things, too, for the first time this year. You know, looking at the fact that if there is a downturn, we want to be ready, and we're going to be in some shorts to help hedge against that.
Okay, thanks for sharing those thoughts. And with that, with the market almost ready to open, we'll call it a day. Great insights, gentlemen. Thank you one and all, and be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.